Ever wondered what happens when the stock market goes into freefall? Imagine waking up one morning to discover that your hard-earned investments have vanished overnight. Sounds like a nightmare, right? Today we're diving into the most shocking stock market crashes of all time, uncovering the causes and impacts of these financial disasters. From the roaring 20s to the tech boom of the 2000s, stock market crashes have been pivotal moments in financial history. These crashes didn't just wipe out billions in wealth. They triggered widespread economic hardship, job losses, and long-lasting financial instability. In this video, we'll explore the top 8 stock market crashes of all time, examining what led to these dramatic downturns and what we can learn from them. Buckle up, because these stories are anything but ordinary. Stock market crashes are more than just historical events. They're markers of significant economic turmoil. They affect everyone, from individual investors to global economies. Understanding these crashes helps us grasp their broader economic impacts and prepares us for future financial uncertainties. So, what exactly caused these catastrophic downturns, and how did they reshape economies and lives? Let's find out. The Panic of 1907. The Panic of 1907, also known as the Knickerbocker Crisis, is one of the earliest major crashes in American financial history. It began with the failure of the Knickerbocker Trust Company, one of the largest banks at the time. When depositors rushed to withdraw their funds, it triggered a wave of bank runs across the country. This panic led to a severe contraction in the economy, with businesses failing and unemployment rising. The crisis was exacerbated by speculative investments and a lack of liquidity in the banking system. The failure of major financial institutions and the resulting economic downturn led to widespread public fear and a loss of confidence in the financial system. The severity of the crisis ultimately led to the establishment of the Federal Reserve System in 1913, designed to provide stability and prevent future financial panics. The Great Depression, 1929. The Great Depression, starting with the Wall Street crash of 1929, is perhaps the most infamous stock market crash in history. On October 29th, known as Black Tuesday, the stock market lost billions in value. The crash was fueled by rampant speculation, excessive borrowing, and a lack of financial regulation. Investors had been buying stocks on margin, meaning they borrowed money to purchase shares, which amplified their losses when prices fell. The Great Depression led to massive unemployment, with nearly a quarter of the American workforce out of a job. It caused widespread economic hardship, with businesses failing and banks closing. The Depression had global ramifications, affecting economies worldwide and leading to severe poverty in many countries. The crisis prompted significant changes in financial regulation and economic policy, including the New Deal reforms introduced by President Franklin D. Roosevelt. The crash of 1987, Black Monday. On October 19, 1987, the world experienced one of the most dramatic single-day declines in stock market history. Known as Black Monday, the Dow Jones Industrial Average plummeted by 22% in just one day. This sudden crash was driven by a combination of factors, including computer-driven trading programs, overvaluation of stocks, and geopolitical tensions. The rapid and severe decline in stock prices shocked investors and led to widespread fears of a global economic collapse. The crash was exacerbated by the use of automated trading systems, which accelerated the decline as sell orders were executed in rapid succession. Despite the severity of the crash, markets eventually recovered, and the event led to reforms in trading practices and financial regulation to prevent future occurrences. The Dotcom bubble burst, 2000. The dot-com bubble burst in 2000 marked the end of a period of excessive speculation in internet-based companies. During the late 1990s, investors poured money into tech stocks, driving their prices to unsustainable levels. Many of these companies were unprofitable but had high market valuations based on future growth expectations. When the bubble burst in 2000, many of these tech companies went bankrupt, leading to significant losses for investors and a downturn in the stock market. The burst of the dot-com bubble led to a recession in the early 2000s and highlighted the risks of speculative investment and the importance of evaluating companies based on their actual financial performance rather than hype and speculation. The financial crisis of 2008. The 2008 financial crisis, also known as the Great Recession, was triggered by the collapse of the housing market and the failure of major financial institutions due to exposure to subprime mortgages. During the housing boom, banks had issued risky mortgages to borrowers with poor credit histories, leading to a housing bubble. When housing prices began to fall, the value of mortgage-backed securities plummeted, causing severe losses for banks and investors. The crisis led to a severe global economic downturn, with massive bailouts for banks and widespread unemployment. The financial meltdown revealed the dangers of excessive risk-taking and inadequate financial regulation. It led to significant changes in financial regulation, including the Dodd-Frank Wall Street Reform and Consumer Protection Act, aimed at preventing future crises and protecting consumers. The COVID-19 crash, 2020. The COVID-19 pandemic caused a sudden and severe stock market crash in March 2020. As global lockdowns and economic shutdowns took effect, fears of a prolonged recession and economic downturn led to a rapid decline in stock prices. The crisis was marked by extreme volatility, with markets experiencing sharp declines and sudden recoveries. Governments and central banks intervened with unprecedented stimulus measures to support economies and stabilize financial markets. The swift recovery of the stock market after the initial crash was fueled by these measures and the eventual rollout of vaccines. The COVID-19 crash highlighted the impact of global crises on financial markets and the importance of timely and effective policy responses. The 1973 oil crisis. The 1973 oil crisis was triggered by an oil embargo imposed by OPEC, Organization of the Petroleum Exporting Countries, in response to the Yom Kippur War. The embargo led to a dramatic increase in oil prices, which had a ripple effect on the global economy. The sudden spike in energy costs led to inflation, unemployment, and a severe stock market downturn. The oil crisis exposed the vulnerability of economies to fluctuations in energy prices and highlighted the need for diversification and energy security. The economic impact of the crisis was long-lasting, with many countries experiencing prolonged economic stagnation and high inflation rates. The South Sea Bubble, 1720. The South Sea Bubble is one of the earliest examples of a speculative bubble. The South Sea Company was established in Britain to trade with South America, and investors were promised enormous profits from this venture. The company's stock price soared as investors poured money into the scheme, driven by hype and speculation. However, the company's promises were largely exaggerated, and its actual trade prospects were far less promising. When the bubble burst in 1720, the stock price collapsed, leading to significant financial losses for investors. The South Sea Bubble revealed the risks of speculative investment and led to financial reforms in Britain to protect investors and regulate financial markets. These crashes are more than just historical events. They reveal deep insights into financial systems and human behavior. The key moment in each of these stories is the point where confidence erodes and panic sets in, leading to widespread financial devastation. Whether it's over speculation, geopolitical tensions, or global crises, each crash tells a story of vulnerability and resilience. The reactions and responses to these crashes have shaped financial regulations and policies, influencing how we approach and manage economic risks. If you found this video insightful, don't forget to subscribe for more deep dives into financial history.